let me give you the snapshot. So there's the house, $350,000 that they owe. There's the investment condo. They had an equity line of credit on the house. And then they owned a truck. They had a truck loan, a boat loan, and a student loan. All of that equaled about $62,000. So, as I told you, they were spending right at $56,000 a year in payments. That's about almost $5,000 a month, right, in payments. Boom, boom, boom. How much money is going to the traditional banks? $56,000. How much money is going to their family bank? That's the name that Nelson shared with us. Their family banking system. That's their pocket, right? Right now, how much is going into their pocket? A goose egg. Zero. Like Nelson said, we got to reverse the polarity of that, right? We got to figure out how to get a few cents out of that red column into the green column. So how do we do that? They were investing $100,000 a year. They told me they wanted to save $100,000 a year. So we parked it in one of those policies, just like Nelson showed us. Has to be structured properly. We parked it in a properly structured policy, and in month 2 they had contributed $100,000 with the guarantees that it could never go down in value, the tax advantages of it growing like Nelson showed us our check did, every day, every week, every month, every year, without taxes. I remember you were clapping back there. That's pretty strong, right? Absolutely. In year 1, they were able to take a policy loan. And what does that mean? That means the insurance company, just like Nelson when he went and bought that timberland, the insurance company gave them a loan of $83,000 and said, here, take this, because we have your money as collateral. A little bit different. They didn't pay cash, right? They could have taken the 100 and just applied it to principal, couldn't they? Wouldn't that have been a strategy? But once they did that, how much interest would they have earned on that $100,000? Zero. Now we parked it, and we just started a system that's going to compound interest until they're 84 years old and above, right? And it's going to grow every year. We started it right now. So we didn't pay cash and give up the opportunity to earn interest. We started where we can start growing our money, and we were able to leverage that. The insurance company gave us a policy loan, and look what we did. We went over and paid off the truck, the boat, the student loan, and the equity line immediately. By doing that, Joey, coming from the mortgage side, it allowed us to refinance the house. We were able to refinance the house to give them more control of their cash flow utilizing an interest-only mortgage. Well, all that means is that lowers their payment so that every time they make a principal payment, they control more and more and more of their cash flow. So let's look at what we did. Paid all those off, refinanced the house. Now, just by taking that one step, 31 days after we initiated this plan, I want you to now look at how much is going to the traditional bank. What was going there? $56,000. What's going there now? $33,000. That's pretty substantial. How much is going into their family banking system, into their pocket, 31 days after initiating this plan? I mean, we've knocked a big hole in that, right? Almost 50%, cash flow-wise. Everybody follow that? So Nelson talked about not stealing the peas, right? He talked about the grocery store and thievery. Is that a word? Thievery was the biggest problem. I made that up. Stealing, right? So we're not going to steal. Here's what here's what common sense, here's what old world planning would say. Hey, your payment's only $33,000 a year now. We can spend the other $22,000. No. We have a responsibility to ourselves and our families, right? Our cash flow was $56,000. We're going to continue to pay $56,000, but we're changing the characters in the play, as Nelson tells me all the time. Now we've inserted our family and ourselves into this equation. So the traditional bank's only getting $33,000. My family banking system, I am now repaying my policy the $22,200. Now, why would I do that? Why would I repay myself, my policy, my family banking system? There's one simple answer. Because it's more money, right? It's more capital in our pocket. It's more money moved to the asset column from the liability column. And that allows us to speed up Anybody ever heard of the old debt snowball? There's a guy on Michael Hart's radio station that talks about that. It's called a debt snowball. It's called a debt snowball. And there's some validity to it, right? So let's do the same thing, but let's earn interest on it the whole time. Let's don't just empty the glass where we're not earning interest. Let's earn interest on it the whole time. So here, again, they were now saving, they were investing. Now they're saving $100,000 a year. Everybody see that? So they've got access to $90,000 of the $100,000 they saved in their policy, plus the $22,000 that they paid back, right? And we said, why would we pay it back? Because it's more capital. It's more money for us. So now we can accelerate our debt snowball. So we take the 90 and the 22, I'm just rounding, that's close to 110. What do you think we're going to do with it? Somebody help me. That's it. We're going to put it on the house. And we refinanced it. That takes our principal down to $240. What does it do to our payment to the traditional bank? Cuts it. So now look. Now we've really reversed the polarity, right? Now we're well over 50% going into our family banking system to benefit us and our families and the things that we care about. And less, this is 13 months later, guys. 13 months from starting the plan, 13 months later, we've gone from $56,000 going to the traditional bank, $0 going in our pocket, to now $23,000 and $32,000 going in our pocket. So now our snowball is building. So let's get out here. 2 years after implementing this plan, we're now saved $100,000. We have access to $95,000 of the $100,000 plus the $32,000 we paid back because we didn't steal the peas, right, Nelson? We were honest bankers. We were responsible to ourselves and our finances. And now we have a little over $125,000. We can apply it to the house loan. You kind of see the pattern that's setting up here, the snowball effect. So what's going to happen to the balance of the house? Drops. What's going to happen to our payment? Down to $16,000. Now let's talk about risk for a minute. We talked about what risk is, right? Possibility of harm or a loss. We've talked about financial planning, and we've talked about that things change, right? And we've talked about that all the variables that affect financial planning always change, because change is constant. So I want to ask you guys a question here. We're now 2 years into this plan, and let's say my client loses their job or their practice suffers and their income goes way down. I want you to think for a minute about risk. Which way is this client safer? Owing $16,000 a year to the traditional bank and having all this money in reserve that they can access? Or owing $56,000 to the traditional bank? Can you call Joey? You were in the mortgage business. I'm sure, and I had a mortgage with Joey. I'm sure if my income had gotten bad, I could call you and say, hey man, let me take 6 months off till I get back on my feet, and then I'll catch up. That'd work, right? To move? That doesn't sound very secure. It doesn't sound very secure for my family, right? But I'm sure the car loan, I'm sure they would have done that there, for the truck loan. I'm sure he could have called and said, hey, had a medical situation come up in my family, my income's down, give me 6 months. They're going to come take the car, right? Bad people, isn't that what you talk about, Nelson? Canine in their lineage, they're going to find you, come get you. That's exactly right. So from a risk standpoint, from a safety standpoint, I want you guys to tell me, which way are they safer 2 years into the plan? Anybody disagree? That from a cash flow standpoint, they're safer? From an asset standpoint, they're safer? Has their cash flow changed? The cash flow to them's increased, but overall net flow hadn't changed any, right? All we did was make a couple of tweaks. We understood savings versus investing. Made a tweak to take more money from the red column and put it in the green column. That's as simple as I know how to make it. That's why when I saw this, when Nelson introduced this to me and I dug into it, I realized this can make a difference. It's a foundation. Can we do other things around it? Yeah, just like a bicycle. You got a hub and then the spokes, right? This is the hub. This can be our foundation. As long as we have the responsibility to utilize it the right way, and you partner with a coach that knows how to do it, number one, and is doing it themselves for their family, now you can lay the foundation. Let's see what happened with this couple and how it worked out. 3 years into it, you see the flow, put in 100, had access to 101 because of all the growth, plus the $39,000 that they paid back to their policy loan. They were able to pay off the house, pay down on the condo. Most of the money is flowing back to them. You see the pattern. I can tell you this is where we are right now. We just went through this. We got emails. Russ and I got emails thanking us. They paid off the house, the condo. They paid $550,000 worth of liabilities off in 4 years and 1 month. They reversed the polarity completely to where the payments they were making that they were going to be obligated to make for years and years and years, they're now repaying that into their system. They're paying their policy loans, their family bank back. We've totally reversed the polarity, right? Now, all the red that was going to your point, Diane, going to somebody else's bank is now all green. It's coming to their control. I'm a picture guy, but for some people out there that are a little more analytical, a summary. We started out wanting to create a family banking system that was built on a solid foundation, that had a savings component, minimizing the risk. So in year one, we began that banking process. We set it up right. We funded it properly in the right type of policy, just like Nelson showed us. From there, we used it to pay off the truck, the boat, and the student loan and the line of credit. We refinanced our home to an interest-only loan. From year 2 through 5, we kept the snowball effect rolling so that we could pay the principal down, completely take over all those loans. Now, the action, the verb, is now coming to focus, right? It's now coming to focus. We have now become our own banker. So years 5 through 9, we continue to pay the same amount to replenish the policy loans. All the money is in our control. Now we have built up a system that from year 9 on we can use to buy new cars for our family, for our children. Buy investments. I'm saying there. For weddings. They have a daughter. That's expensive. Joey, you got one of those. Russ, you got 3 to look forward to. Just not trying to, get you depressed. Retirement. That was the initial plan that they thought out. They wanted to retire early to travel and do some really cool things, to be a part of their church, to do mission work. They wanted to retire early so they could dedicate themselves to that. The plan they felt like wasn't getting them there, right? New economy, old plan. They want to buy a second home at some point, and I told them I had a beach condo, so I'm holding it for them. They can have it. They can increase their charitable giving, right? There's so many things. They can grow their business if they want to grow their law practice. They have capital in order to do that now. Pay for college. But it goes back to a couple of key points. No change in cash flow. No additional risk. No tax on the growth. And a guarantee that they're now in control of their finances.